Hello everyone. Today the topic which I am going to take is derivative. Clear? So till now we have some basic idea of derivative, that what derivative is. Derivative is an instrument which derives its value from its underlying, Clear? Now first of all, let us see that derivatives are of how many types. Derivatives are broadly described into two parts, one with the forward commitment, and another one is the contingent claim. Forward commitment, or we can say when we have a commitment, okay, means in any situation I have to fulfill something. Means if I have told you and I had a contract with you that after 1 month I will buy 100 apples at the rate of 40, then I have to buy it, okay, because it's a right as well as obligation. I have the right to buy apple, I have an obligation to buy apple, they both are there. When I am saying right, means you cannot go away from there, and when I am saying my obligation, I cannot go away from there. Similarly, you have the right to sell as well as you have the obligation to sell. We call it as a forward commitment. But there is another type of derivative, that is contingent claims. Contingent claims means if the situation, the event will take place, then only I will buy the apple, or then only I will sell the apple, otherwise I won't. Means suppose the event like this, that if the price of the apple in the market will go above 60, in the market if the price of the apple will go above 60 and I had a contract with you to purchase apple at the rate of 40, then only I am going to buy. So means it is dependent, it is contingent on the event that the price of the apple will rise. Okay, similarly there can be the contingency, like if you want to sell and you want only the right to sell rather than the obligation. So you say that I am going to sell the apple at the rate of 40 only if the market price will fall below 20. Clear? So in the contingent claim, we are going to study about two things. One is options, and another one is the credit derivative. And the example of credit derivative is CDS, and the examples of options, one is call, another one is put. Clear? So contingent claim are of two types, options and credit derivatives. Options are further divided into call and put, and credit derivative is further into credit default swap. Don't take the word swap, okay, just follow that, the credit default swap. Why it is the part of contingent claim? Because the buyer of the CDS will get the money only if the underlying company will default, so it is contingent on an event, it is contingent on an event of the default of a company. Clear? Now coming to forward commitment, over here we have three major categories. One is futures, another one is forward, and another one is swap. Futures, forward and swap. Now in these three we have the right as well as obligation, that I have to perform something, but in this scenario the buyer will have the right to buy, depending upon, suppose I am the buyer of a call option, I have the right to buy. I have bought put option, I have the right to sell. But the seller of those options have the obligation. Means try to understand the fact. If I am a buyer and you are a seller of call option, I said that I will buy the apple at the rate of 40 from you if the price will go above 60, otherwise I won't. So means there is no obligation at me that I have to buy it. But from your perspective, Suppose the price reached 45 and still I said that I want to buy apple from you. You cannot deny, you cannot deny. Why? Because I can buy apple from you at the rate of 40 and in the market it is trading at 45. So still I have a profit of 5, but over there you cannot deny that I cannot sell, because you have the obligation to sell the apples at the rate of 40. Clear? But it's my right that if I want to buy apple at 45, I can. But if I don't want to buy, you cannot force me to buy at 45. Clear? So over here the buyer of the option have the right. Buyer of the option have the right, but the seller of the option have the obligation. He need to perform at any possible situation. Clear? But over here the contract, if I am entering into a contract, I have to fulfill it. So there is right as well as obligation. Try to understand a simple example that I entered into a future contract. It's a contract to buy apple. At the rate of 40 per kg. So over here Mr. A, Mr. B. So Mr. A is the buyer of the future. I denote it by F plus, and he is the seller of the future. I denote it by F minus. Clear? So I said that after 1 month I will pay you 40 and you will give me 1 kg apple. 1 kg apple. Clear? Now after 1 month, whatever the price will be, whether it will become 48 or it will become 32. After 1 month, the price is fluctuating of the apple. It's not constant. So there is one person who will gain and there is one person who will lose. Clear? But what's my right? I have the right to buy apple. I have the right to buy apple from Mr. B at the rate of 40. What's the right of Mr. B? His right is to sell apple at the rate of 40 rupees per kg to Mr. A. What's the obligation? Even if the price will reduce to 32, I have to buy it. I cannot move back from my contract. If the price will reach 48, I have to sell it at 40. I cannot move back from my words. So this is a contract which binding both the parties and they need to perform both right as well as obligation at the same time. Clear? So we have futures, forwards and swaps. Now, if I enter into the discussion of derivatives, there are three things. One is the introduction. That is the meaning, the definitions, the explanation of all those products like futures, forwards, call, put, options, swaps, CDS. What's the meaning of that? What are they? Clear? Next is the pricing and valuation. Means what should be the price of the call? If you are buying a call option, you have to pay something, right? What should be the price of the call? And suppose your contract is of 1 month. If your contract is for 1 month, but if you want to stop it between say 15 days, contract is for 1 month, but you want to stop it within 15 days, what is your profit and loss? That is valuation. Because if you want to stop it between 15 days, then either you will receive something or you will gain something or you will lose something. So what is that amount which you are going to lose or receive? And the last one is the application, that how you are going to use this derivative in the real life example. Means you feel that the market is going to say 17,000 from 14,000. So means you are bullish on the market. Then what are the possible options do you have? You have the possible options of, say, you can enter into F plus, that you can buy the futures on the index. You can buy call option on the index. Simultaneously, you can enter into P minus, that is you can sell the put, because if you are bullish, then you can sell the put option as well. Okay, you can sell the put option as well. So they all will help you to gain over the perception of the market. If you have the perception that it is going to rise, you are going to earn money, and then accordingly you will take the trade. Because if the market will increase from 14,000 to 17,000, you will earn 3,000. Clear? So that is the application, pricing and valuation, and then introduction. Clear? Now Let us move ahead. Now forwards and future. Forward and future. Over here you see we have forwards and future. Now trust me, they both are same. Forwards and future, they both are same. In some respect they are different. First of all, what is the difference between forwards and future? Forward is over the counter derivative. Forward is OTC. OTC, over the counter, means there are two types of trade. Suppose I want to buy the futures, or I am bullish in something. I am bullish in something. I want to buy. So I have two options. Either I can buy futures or I can buy forwards. Where I will find futures? Exchange, stock exchange. Okay, there you will find standardized. Okay, standardized futures. But suppose you want to enter into a contract with your friend directly. Okay, he is there in your class, and you want to enter into a contract in which you are bullish and he is bearish. That is over the counter. Or suppose some a big business client, okay, and he has a very huge derivative to trade into. He was suppose a oil trader. He is afraid of the fall in the price of the oil, because he have a huge stock of oil and he need to sell it into the market in the coming days. So he is afraid of that the price of the oil will decrease. Then he purchase say 100 rupees per liter, and suppose it will reduce to 80 per liter. There is a huge loss to the trader. So what he will do? He will enter into a future contract with his friend or with any investment banking firm. He will say, I am short on the oil. I want to sell the future. Would you like to enter into a trade with me where you are bullish and I am bearish? The third party will say, yes, let us enter into a contract. That is over the counter. Suppose I reach Goldman Sachs and I am bearish on the oil. They will enter into a bullish trade. I will enter into a bearish trade. I am the forward seller. He is the forward buyer. These all contracts are over the counter. Apart from these, the pricing and all, they are more or less same. The only difference is comes to that futures are exchange traded. So there were a huge amount of regulations, rules and policies. There is a mark to market feature every day. But in forward, that is totally dependent upon the mutual consents of both the clients. Apart from that, there is a central counterparty which keeps on doing the mark to market on periodic basis, might be weekly, might be monthly, might be yearly, semi-annually, depending upon their contract and mutual trust. Clear? Apart from that, the way they are traded, they both are same. Clear? And when it comes to the swap, I am giving you a small example so that you can understand. I feel that the share price of the Reliance is going up. And you feel that the Infosys price is going to go up. Clear? You are bullish on Infosys. I am bullish on Reliance. Try to understand. Mr. A, Mr. B. He is bullish on Reliance, but I am bearish on Infosys. Clear? But with Mr. B, he is bullish on Infosys and he is bearish on Reliance. Clear? So I will say that you will give me the return. You will give me the return of Reliance. I will give you the return of Infosys, because I feel that the Infosys price is going to go down. So I have to give a very small return to Mr. B. But the return of Reliance is going to be very huge. I will take a huge amount of money from Mr. B. Similarly, if you will think it from the Mr. B's perspective, he feels that Reliance is going to underperform as compared to the Infosys. So the profit to Mr. B is going to be very high. Swap. You can see they are swapping the return of one account to another account. Clear? Now, when I am saying this futures, forwards and swaps, or we can say forward commitment. Clear? Now these forward commitments are done on equity like stocks, Amazon, Reliance, Flipkart, anything. You can do it on bonds, or you can say fixed income. You can do it on bonds. If I'll give you an example, bonds, I am feeling that the interest rate are going to go down. So means what? The price of the bond will go up. So I will buy the futures of the bond. I will buy the futures of the bond to make huge amount of money. Similarly, we are going to have a forward on bonds. Clear? We can have a swap on bonds. means I believe that the interest rate are going to rise. So what I'll do, I will give you fix 6%, 6%, 6%, and I will take you floating. So means floating means what? The new interest rate which is coming into the market, and I know it is going to increase. So I am going to take you the increased interest rate while I am giving you fixed 6% return. Suppose the interest increased to 8%. I will take 8%, I will give you 6. My profit is 2. Again, next quarter, interest increase to 9. I will take 9 and I will give you 6. Clear? So this is how we actually trade in swap with different structures, different asset class. Clear? We can do it interest rate. Okay, there is a forward and future on the interest rate. Clear? Then we can do it on currency. I am bullish on dollars, I am bearish on pound. Clear? I'll buy the futures of dollars. Clear? We can do it on commodity. Clear? So what we have to understand over here, is the meaning of the derivative on each of this asset class. First of all, we have to do the derivative on each of this asset class. The meaning, that what is the meaning of that I am doing a derivative on equity? What is the meaning that I am doing a derivative on bonds? What is the meaning that I am doing a derivative on interest rate? One of the example is FRA, forward rate agreement. Forward rate agreement means I am believing that interest rate today is 6%, but after 6 months the interest rate is going to be 8%. I am bullish on the interest rate. I am going to enter into an FRA. I am going to enter into an FRA where I am going to be the buyer of FRA. You feel that interest rate is going to go down, you will become the seller of the FRA. Then whatever the difference, we are going to either earn or you are going to earn. Clear? One party will earn, the other party will lose. Similarly, the example I have given you, I am bullish on dollars, bearish on pound. Buy the futures of dollar, sell the future of pound. Clear? Commodity, gold. Simple. If you are bullish on the gold, buy the futures of the gold, sell the future of the gold. If you are bearish, you can buy the option on the gold, you can buy option on gold. If you are bullish, buy a call. If you are bearish, buy a put. Clear? Getting my point? So with respect to forwards, futures and swap, we need to understand that how these different asset class are going to work. Clear? Now with respect to swap, you can write it down over here. With respect to swap, our focus is going to be on interest rate, equity and currency. Interest rate, equity and currency. These are going to be the focus. So over here I have given you a brief introduction that what we are going to study. Okay, what we are going to study, and the pure focus will be on this futures, forwards and swap. This is the area where I am going to start with you, futures, forwards and swap, and then we'll move into the contingent claims. First of all, my target is to complete this forward commitment area, that is futures, forwards and swap. So one by one we will pick up every asset class and we will complete the forward and futures, and then separately we will enter into the swaps in the later section. So I have given you a brief theme that how I have to take the derivative. Now there are many students who feel derivative is difficult, but trust me, the way we will start each and every point is going to make things very easy. Now the pattern of study over here which you need to follow is to ensure that, suppose if you are watching a class on FRA, okay, watching a class on FRA, so while watching the class, make sure that you will prepare your notes, you will solve all the class notes, solve all the class questions. Now apart from the class questions, I am going to give you some assignments. Okay, some assignments to solve them, and simultaneously we will work on some item sets. Clear? So once you are done with step by step, trust me, your FRA is going to be very strong, and I will try to give you as many questions as possible. Even some questions you might not find anywhere in the material, I will prepare them for you so that you can practice more. Okay, because trust me, if you look for the FRA questions, you will find like 5 questions or 10 questions. Clear? But I will try my best to make it 15 or 20 or 30 questions, so that the more you will practice, the more you will gain knowledge and understanding. Clear? So I am winding up this lecture here. I have given you a brief understanding. So from the next lecture, my main agenda is to start with the forwards in the futures. Clear? Thank you.